Welcome to the Property Franchise Group full year results webinar. I now hand over to Gareth Samples, CEO, and David Raggett, CFO. Gareth, over to you.
Good morning, everybody. Many thanks for attending today's roadshow. I'm here to talk about the Property Franchise Group's final results for 2020 and give some colour to the acquisition of Hunters Property PLC that we completed on March the 19th. To start off with a little bit about us, we were formed by our chairman, Richard Martin, in 1986, who grew a very successful franchising business up to 100 offices by 2007, and then carried on growing the business and decided to float the business in 2013. In 2014, we acquired another franchising business from Legal & General, the Xperience Franchising Group, and Whitegates Estate Agency Limited. And in 2016, we acquired a hybrid estate agency called EweMove, that we'll talk about a little bit later. In 2017, we rebranded to the Property Franchise Group, and by 2019, we were managing 58,000 properties across the entire group. In 2020, we launched a financial services strategy, and in 2021, we acquired the Hunters Estate Agency Group and announced yesterday our strategic partnership over the next 5 years with LSL's mortgage broker arm, the Primus Mortgage Network. So that gives you a little bit of information about us as a group. To give you a summary of 2020, I started as CEO. I took over in February of last year, and by March I was in lockdown and told to stay at home. So it was a baptism of fire coming into the group. But what it enabled us to do in that sort of 3-month initial lockdown is really get close to our franchisees and understand, what they were happy about, what they were unhappy about. That they were very fearful at the time that we were going into sort of an Armageddon scenario. Nobody had any experience of managing their way or managing a business through a pandemic. So our job as a franchisor was very much about supporting our franchisees, informing them about the strategies they needed to adopt, interpreting all of the government schemes that were being sort of launched on a daily basis to provide support for businesses in the UK, and just act as that sounding board to answer any questions, to give the information required for them to make the right decisions about their business. And I'm delighted to say that they navigated their way through that crisis really, really well. And as soon as the government reopened the offices, allowed the offices to reopen in May, we were then into sort of phase 2, which was all about health and safety and PPE and hand sanitizers in every toilet and every doorway, and the offices reopened, and by June the activity levels had come back, bounced back, and were probably trading above the levels pre-COVID. And we put that down to sort of the uncertainty around Brexit in 2018, 17, 19, and obviously the election, that there was some pent-up demand in the market, and that certainly returned as soon as lockdown was released. The government then, and they've made a couple of decisions since the initial decision about stamp duty. The government then decided that the property market was very, very important to the overall health of the economy, and took away the sort of stamp duty hurdle, and that supercharged the market in the back end of last year. So the number of sale agreeds that we were able to achieve in the back end of 2020 were at record levels. We also gave a presentation in September, our half-year roadshow, where we talked about the sort of pillars of growth as we saw them in the Property Franchise Group, and we articulated what they were, and that was very much about organic lettings income growth, acquisitions of local lettings books by our franchisees, the opportunity, if it arose, to acquire one of our peers, which we did ultimately with Hunters in March, a financial services strategy to deliver to our franchisees a best-in-class financial services offering, which we announced yesterday, the doubling in the size of our hybrid estate agency, the doubling of the territories from 115 territories to 230 territories over a 2-year period, and all of that backed up through a best-in-class digital marketing strategy that we're working on. Now, they were aspirations back in September, and I'm delighted that we'll talk about a number of those aspirations becoming a reality in a very short period of time, 6 months. So we've delivered on the financial services strategy that we announced yesterday. We've delivered on the Hunters acquisition. We've continued to grow our EweMove footprint and have just had our record quarter in terms of new territories sold. We've made really good progress on our residential sales growth within our traditional brands, and we're making good progress on our organic lettings growth and lettings book acquisitions. So I guess if you'd have asked me 6 months ago, if you'd achieved all this in 6 months, would you be happy? I'd have been absolutely delighted and great that we've put loads of ticks in boxes. But the fact that we've delivered so much means that, the next 12 months we've got a lot of hard work to settle everything down and start to deliver value to the group. That gives you a little bit of colour around 2020. I'm also delighted to say that we delivered a record profit before tax that David will talk about a little bit more later, and a record EBITDA result. So throughout a very uncertain period, I think we look back and say, actually, we delivered an exceptional result in very testing circumstances. So David, financial overview.
Good morning, everybody. I'd classify or describe 2020 as a year when lettings income came into its own and the resilience of lettings income. And the reason for that is, although there was a lot of sales activity in the second half of the year, very little of that extra activity crystallised into revenue for ourselves, or indeed most of the estate agents up and down the country. So that's a story for 2021 that I'll come on to. So it was all about lettings income. It was all about cost control in 2020. And as a result of keeping an eye on our costs and having a very large managed portfolio and a lot of transactions that were taking place, we managed to keep our group revenue up. It was up slightly on 2019. Our royalties were down slightly, having been shut for 2 and a bit months and taking a bit longer than that to sort of get back up to speed because of the very nature of having to deal with the COVID restrictions. It was difficult to make up those lost couple of months. But again, royalties or management service fees, not tremendously different, 9.4 million in 2020, 9.7 million in 2019. I think the most important thing for us is that we like to maintain a healthy operating margin. Its target to usually be around 40%. It was 42% in 2020, and that allows us to generate a good level of EBITDA and a good level of adjusted EBITDA. That's the EBITDA with just any accounting entries that we need to make to get to a reported result under the standards adjusted out. So 5.7 million in 2020 versus 5.3 million in 2019. Profit before tax up 20% year on year, back to paying a healthy progressive dividend of 8.7p, and partly because we hadn't paid a final dividend in 2019, partly because of all the cost control and the lettings resilience, we had a net cash position of 8.8 million at the end of 2020, and that allowed us really to take on the next stage of our strategy. Revenue in 2020, the most notable thing about revenue was that we started on a financial services strategy, and for the first time ever in a total revenue, financial services represented 4% of total revenues. That's never happened before in the group. We had set a target a few years ago to get to 5%. So I suppose you could say in 1 year, one full swoop, we'd nearly done it. But I mean, we weren't going to rest on our laurels at that point. What's been happening in 2021 is the interest for me. The early part of 2021 is captured in these dotted lines. So on the left-hand side, you've got lettings MSF. Transactions are closely aligned to income and come very quickly after the transaction. So you will generate your income a month after your transaction at the worst. And therefore, what it tells you is that transactions were relatively suppressed in January and February 2021 for lettings. And I think the lockdown was just playing on everyone's mind, quite rightly so. No one wanted to move. Tenants were staying put. Come that plan that was outlined by the government, as to how we get out of lockdown, tenant activity started to pick up. And as a result, you can see income started to pick up, and it's progressed pretty well to the end of March now. So we're seeing levels that we haven't seen in prior years. Will that continue? Well, I think it probably will for a while at least. What's driving the sales market is almost certainly driving tenants. It's beyond stamp duty now and stamp duty holidays. There's the more fundamental shift going on there. And on the right-hand side, you see what's happened to our sales MSF. Now, this is as a result of the pipelines built up in 2020, generating income as sales go through. So there is a delay between the sale agreed in this country and the sale going through and the buyer being able to move into the house they bought. Typically, that's been 3 to 4 months. In the last 6 months of 2020, that was 5 to 6 months. And that's just because we've always had this bottleneck with conveyancers, surveyors, local authority searches. It's getting harder to get mortgages because there's more information that's required and takes longer. Everyone working at home as well, there just started to be an inability to serve the demand that was there for those services, hence the timelines went out. But 2021 has started well, and those pipelines have started to deliver their income to us. They're not very much changed, those pipelines, since the end of last year. So they, where we end the end March 21 is almost in the same position with sales agreed pipelines as we did at the end of 2020. And that is going to take us through that sort of pipeline in terms of income up until probably the end of the third quarter of this year. So we're already starting to think about what's the end of the year look like for us. EweMove, which is our hybrid brand, predominantly a sales-orientated business, is showing exactly the same pattern. On the left-hand side, we see transactions completed so far this year, all coming off their pipeline they built in 2020. Clearly a scale that's completely different to the prior years. Will it continue? Well, I think, the answer to that is it is for a period of time. Why are we confident? Well, in February, we started to see a lot of transactions starting to take place. And we saw a lot of interest. We saw a lot of people looking to start to either put their property on the market or look to move again. And as a result of that, they knew they weren't going to get those buyers who have sold or bought a house before the stamp duty holiday expired, because it was due to expire in March. But they were very keen to get out and to seek out the property that they really wanted. And as a result of that, you have to say there's something other than just a stamp duty holiday driving our market at this moment in time. And on the right-hand side, sort of scales are a little bit distorted there, but you've got the impact on sales transactions and then lettings, which is, most important thing for us to keep our eye on as a business is where are we on lettings, because it is the dominant income stream for us. So when transactions are slowing, despite our managed portfolio being quite as high as it is, we do start to see our lettings MSF start to drop back. And it started even in EweMove a bit slower than prior years, and now it started to pick up again, and that is very, very pleasing to see. 5-year trends, just for anyone who hasn't seen us as a business before, turnover grew steadily through the years from 2016 to 2020. We have been through a tenant fee ban in that time, which had the impact or potential impact of reducing revenues by £1 million. So there's been quite a lot of work that's had to be done to recover that. Otherwise, that trend would have been better than it is right now. Royalties were grown year on year right up in 2019. And then, of course, the pandemic's just impacted us a little bit in 2020. Profit before tax, it's a good trend. Could have been better, but for 2019. But, a good consistent trend of where we are trying to go to, 50% up on 2016. So that's good growth. And then the last number on this page on the right-hand side, the one that I keep an eye on, is adjusted EBITDA. It excludes those accounting adjustments that we're required to make to get to our PBT, and therefore gives me a good indication of a true trend in the business. And 2016, we're at 3.9 million. 2020, we're at 5.7 million. We're up 49% over those 5 years. That allows us to pay a progressive dividend, but for 2019, where I suppose you could say we blotted our copybook, like many organisations, we didn't pay a final dividend in 2019. We sat on the cash and said, where's this pandemic going to take us? Made a decision it was better to hold on to that cash and have a stronger business in the future than pay it out and risk part of our strategy, or indeed risk the business. So 2020, 8.7 million of dividend per share. I would expect us to go on and keep growing that now pretty well at decent levels for the next few years, at a target of 10p. And I think 2021 is going to be the year that my long-term target is hit. So I've got to set a new one for that going forward. Net cash, we've grown our cash in the business because we are a cash generative business, despite investing as we've gone along the way in our strategy of growth. We ended 2020 with 8.8 million. Of course, that's flattered a bit by not paying a final dividend in 2019, but even if we adjusted that out, it'd be 6.8. So good trending growth there year on year with our net cash. Return on capital employed, I've always wanted us to have plus 20% on this. Ultimately, it's what we do with the money that you all invest, and can we get a return on it? So I figure if we can get a 20 plus return on the equity you've invested in us, then that's a good return, and anything above that as a bonus. So most years we've been above that 20% threshold. And just to measure again, return on capital invested, so that includes bank debt and just what we're managing to return on all the funds that have been provided to us to get a return. Well, we were at 41% in 2020. That's a one-off, really, I would say. A hurdle of 30% is where I've set the business. And if we can continue on that line, then we'll keep generating good earnings and we'll keep generating good progressive dividends and growth in the business. Bit more on cash before I leave the point. We generated 5.4 million of net cash in 2020. That's up 700,000 on 2019, so not an insignificant increase for us. About 110% of our EBITDA is translated into cash from operating activities. So we're highly cash generative in that respect. As an amount of our shares in issue in 2020, our free cash flow, that's the cash that we have either to pay the bank back any repayments or indeed to pay you dividends, was 21p a share. So you can see we've got plenty of headroom there to be able to pay more progressive dividends. And on the right-hand side, what happens with the cash that we actually generate from those operations? Well, the truth of the matter is we support our franchisees in buying portfolios. We do that every year, so that's that 200,000 that goes out. We occasionally buy a business and even sell a business. There's a little bit of in and out there, depending on which year. And then what's left is either money that we are going to, so that's our free cash flow, either money that we're going to pay away in dividends, and every year there's dividend outflow. Some years we have bank debt and we need to pay that as well. But you know, that's it. That's the sum total of it, really. So it's a very straightforward sort of cash position for us, whereby we generate most of our cash out of our operating activities, and we need to invest a little bit back into it, and then we give returns to those who funded us. Over to you, Gareth.
Thanks, David. So really solid foundation, a really resilient business, some really good numbers that have been produced over the last 5 years. What I now want to talk about is sort of the hidden gems within that. And one of our hidden gems is EweMove, business we bought back in 2016, a sort of challenger brand to traditional estate agency, a hybrid working model, so sort of a working from home model. And we provide the franchisees within EweMove a sort of business in a box that gives them everything they need to run a hybrid estate agency in their local area. And the business has gone from strength to strength, typified by winning the best national estate agency and the best national lettings agency award at Peter Knight, who's an influential person within the property sector, his awards in 2020. So we were delighted to win that award just for the recognition that the brand is beginning to move into mainstream, which was really positive from our perspective. I look at their results post lockdown, and one of the things that was really interesting once we came out of lockdown is how nimble the sort of EweMove model and the way they operate enabled them to achieve growth in market share quite quickly. And by September 2020, they'd had their record sales listing result of 729 new instructions. Their previous best was, strangely enough, September 19, when they did 413 listings. So massive rise in the record month in September 20. That then meant that in October 20, we had our record sales month of 423 sales, against a previous best of 239, so significantly up on what they'd achieved before. And I'm delighted to say that they've actually beat that record on sales in 2 of the first 3 months in the quarter. So, what we've got is this business that is growing, quicker than the market, is becoming more recognised nationally as a brand, is attracting far more interest in terms of franchisees registering interest. We had our first franchisee in 2020 turn over £1 million, which was a huge achievement. And we've got a number that are over 500,000. And the number of website visits, we just keep breaking each record. So July 2020, 244,000 visitors, broke that record again in March with 245,000 visitors. One of our strategic aims that we launched back in September was to double the size of the footprint, so double the number of territories we operate in. And at the time, we had 115 territories, and our aspiration was to grow by the end of 2022 to 230 territories. And I'm delighted to say we just had a record Q1 in terms of EweMove recruitment. We've taken 20 new franchisees on, and we now operate out of 135 territories. So this is a high growth business in a space that's been dominated by people like Purple Bricks and Yopa and EweMove, all of which have spent millions and millions of pounds and are actually in decline. And EweMove has grown, relatively steadily, but has now seen that big spike move forward. So this is one of the hidden gems within the business that people, we want them to understand just what this business could become over the next 5 years. So that's a little bit about EweMove. In terms of one of our other strategic aims, the financial services part of the business, it was really, really important once we'd assessed, the business in 2020, that we were able to go out and put together the very best deal from a financial services perspective for our franchisees. And the deal that we announced yesterday really is that. The levels of income they can receive from this partnership are better than they could get anywhere else in the market. And what we've done is turn that into 3 tiers. So our franchisees will either offer a telephone service, so passing a lead into a call centre environment for mortgage advice, or tier 2, which will be Primus Mortgage Network providing an employed financial consultant to deal face-to-face with our franchisees' customers. And tier 3, which is the franchisee actually employing their own financial consultant and becoming an appointed representative of the Primus Mortgage Network. So depending on their ambition and depending on their appetite, there are 3 tiers that they can sign up for. Our job, I guess, over the next 5 years is to move everybody up in tiers. So if you start at tier 1, we'd like you to get to tier 3, and ultimately we'd like you to get to tier 2, and ultimately we'd like you to get to tier 3. And that's just them gaining confidence in their ability to drive mortgage referrals into whichever tier they initially decide. On top of that, and part of our digital marketing strategy, we have the ability to interact with all of the consumers across the group at certain stages. So buyer registration, viewing arranged, offer made, sale agreed. So, identifying the touch points for financial services and communicating with those consumers to drive them into our financial services business is something that we want to do relatively quickly. We also announced yesterday, as part of this strategic partnership, the fact that we're going to do a joint venture on the buy-to-let landlords that each group has. So we currently have 73,000 properties under management. We have another 50,000 tenant find only landlords. LSL have 60,000 managed landlords and about 40,000 tenant finds. So we're looking at 250,000 buy-to-let landlords, all of which require refinancing, release of equity to continue to enhance their portfolio, along with all of the opportunities that come from buy-to-let landlords deciding that they want to sell certain properties. So we want to define a proposition for all of our landlords and to drive as much income opportunity out of that as possible. So that's a little bit about the LSL deal. I've touched on COVID, but I'll reflect on it. So I think the one thing to say is we've emerged a much stronger business. I think the fact that we got so close to our franchisees during a very testing time taught us a lot. Certainly taught me as a sort of new CEO coming into the business what we needed to do as a franchisor to drive the very best result for both our franchisees' business and ultimately our own. So we provided the daily updates to franchisees on government financial assistance, operational advice, HR matters, all of which were really, really important back in March. We negotiated on their behalf, the key suppliers, and were able to negotiate either 0 rates or reduced rates, which helped in the short term reduce our franchisees' cost base. We, at a group level, made our own cost-saving measures, which was really important and shone through in the results that David talked about earlier. We flexed our position on growth initiatives depending on the external situation. And I'm delighted to say, as a result of everything we've done and all of what we've delivered, we've taken the decision to repay the furlough money we received, which was £93,000. It wasn't a lot of money, but we've decided to repay that. In terms of the positive impact on the group, we were able to continue effective operations across the majority of the business. Stronger relationships built with franchisees. Our resilience in terms of our revenue was really impressive. We improved our operating margin, which I guess we weren't expecting. Our cash balances increased, and as David said, we delivered a record profit before tax. So what started off as quite an uncertain year has turned out to be a really positive year. We've learned an awful lot. We've set out our plan, our agenda for the next 3 years in terms of where we believe we can grow the business, and that set us up to be able to complete on the Hunters acquisition, which sort of supercharges our growth going forward. Okay, so a little bit about Hunters, a little bit of history. It was founded in 1992 by Kevin Hollinrake, who's an MP now, and he built a sort of 8-office independent estate agency group up in York that was very successful. Back in 2011, Countrywide, who were at the time the largest estate agency group in the UK, decided they didn't want to be in franchising anymore and wanted to offload their 100 franchisees. And Kevin and Harry Hill, who was running Countrywide at the time, struck a deal, and Hunters went from a sort of independent local estate agent to a national franchisor overnight. That was in 2011. They grew the business for a couple of years and then decided they wanted to float on AIM in 2015, that they did successfully. The group now stands at, it's 210 branches now, actually. So 210 branches nationwide across 3 brands. Predominant brand being Hunters. There's also 2 geographical niche brands. Country Properties, that's hugely successful down in Hertfordshire and Bedfordshire, and Mullocks, again, hugely successful in and around Essex. The makeup of the offices, 38% of them are in the north, just under half are in the south, and 15% of them are in London and the surrounding areas. The team's led by Glynis Frew, who's Managing Director of Hunters post-acquisition, who's passionate about training and customer service and, really brings some good ideas to the group. And we'll talk about that management team a little bit later on. And coming out of 2020, they've demonstrated that they're very cash generative with significant growth potential. In terms of what are their core strengths, they're very, very strong in residential sales. That at the moment is really pleasing because the market is on fire. It accounted for 64% of network income in 2020, slightly down on 2019 that was 66%, and that's because of the lettings growth they've managed to affect in that 12-month period. It's a really strong brand. It's the 3rd largest sales agency network by sales agreed. Their customer service has touched on really big passionate point that Glynis drives through in the business. They've got a 97% customer satisfaction rating. They're very cash generative, 4.1 million in 2020 that again David will talk about a little bit later. And they've got a track record for growth. They are probably the fastest growing franchise business of all of the peers, us, Belvoir, Winkworth. Over the last 5 years, they've opened more units than any of us and done a really good job in terms of converting local independent estate agents with their name over the door to a Hunters franchisee with the Hunters brand over the door. And that's been a successful strategy that they've executed on. In terms of what does it mean for the wider group, and this is really important, so enhanced scale and geographical reach. So we're going to have 430 physical branches managing 73,000 tenanted properties and selling in excess of 20,000 houses a year. So that puts us very firmly in number 2 position in the country. The only one that's bigger is the Connells Group as a result of the Connells and Countrywide coming together early part of this year. What does it enable us to do? It enables the enlarged group to enhance its value proposition to franchisees and customers. And I guess, a sign of that is the deal we did with LSL yesterday. But, we've had, many suppliers come to us and want to renegotiate their deal more favourably for us because of the size that we now have. stronger, more efficient franchise network, and consequently more growth for both groups, which I think is really positive from an investment point of view. In terms of earnings accretion and synergies, we've identified the synergies. At the moment, the market's really, really busy. So, there's no rush to push the button on that. We will pick those up towards the end of the year. We've already made some savings in as much that we don't have 2 listings now. We don't have 2 boards. But, bringing that group together, there is more opportunity to reduce cost. Acceleration of our financial services strategy. Our ambition was to create a business with 100 financial advisors. I think we can grow that still further now as a result of the deal we did yesterday. And the scale of the enlarged group will make more effective use of the advisors and drive both growth and income. We've got a strengthened board with the appointment of Glynis coming onto the board as executive director, and Dean Fielding, who was a non-exec within Hunters, coming across to join the group as well. So a strengthened management team going forward. David, do you want to talk about the structure and the numbers?
Just to give everyone a bit of background, we paid £26.1 million for Hunters Property PLC. 14.5 million of that was cash, and the rest 5.56 million shares. So that's diluted existing holders. So existing holders prior to the acquisition and now got 82.3% of the shares in issue, and Hunters shareholders have got 17.7%. For those of us who were shareholders prior to that point, clearly what we all want to know is the earnings accretion going to outstrip that dilution? And I can safely say if it didn't, I wouldn't have been up for the deal. So it does. It should be good, and that's important, I think, to make that statement. Where are we in terms of Hunters as a business? Well, network income was up slightly 2020 to 2019. Adjusted revenue, I've adjusted out things to do with the pandemic and the sale of owned offices back to franchisees. So we're down a little bit, 4%. The important number for me is the management service fees. That was up from 3.2 to 3.4 million. And bearing in mind that most of that would have been driven by lettings, not sales, because of the nature of the market. That's good. That's good growth. 64% of it still came from sales, which, in this market and their expertise is not to be unexpected, but 36% from lettings. They do have a management portfolio of over 15,000 properties. That's growing month on month, which is good to see. What was attractive, I suppose, and should be borne in mind, is that they finished 2020 with £17.3 million worth of sales agreed in the pipeline. That to be income in the early part of 2021. And for a business that in April had to take a COVID loan of £3.5 million because it was worried about its existence, it finished the year with net debt of 0, which I actually think is phenomenal achievement in 2024. Hunters performance 2020 versus 2019. Key numbers for me to look at, and therefore I'll lead you to them. Adjusted EBITDA 3.5 million, up from 2.8 million in 2019, up 26%. Adjusted PBT at 2.8 million versus 2.1 million in 19, so up 36. And basic adjusted EPS 7.9p nearly versus 5.9p. And why are they important? Well, because they take out the adjustments that the accountants have to make under IFRS, and therefore that's quite, that gets us back to what's the business really doing at the end of the day. So it gets away from the highs and lows that you can see, and it gives us a very good trend of what's happening. On the right-hand side, non-financial KPIs, the ones that I'd take you through really are a number of offices. They're 209 at the end of 2020 and moved slightly now to 210. Offices open, this is where they've been very, very good at converting independent agents into Hunters franchisees. And that is no mean task. We've had a couple of goes at it over the years. We really do understand that it's not easy. They opened 9 offices in 2020. In 2019-20, I think we'll see that sort of somewhere between 10 and 20 openings restored this year, which will be excellent. And then on average office turnover, £200,000 in 2020 is an average office turnover, compares to 335,000 for us. So there's some work to be done there to help those franchisees to grow their income. Certainly some help in regards to winning instructions from landlords, helping them to buy some portfolios to bolster their income. And naturally, they'll benefit a little bit from the bubble that we're in 2021 as well. And the only other item I probably just want to pick out to everybody there is the lettings income. We tend to I think that, sometimes it's just a sales business, but it really isn't. It is a lettings business as well. 15.5 million of income in 2020. That's up 7% on 2019. And for a lettings business, that's good growth year on year. So, well done to them. One last slide from me really is just to say, what really attracted us? What was at the core of this? Why did we move ahead from a financial point of view? And two things I thought were really relevant here. One was the net cash generated from operations. We had a good year in 2020, 15% year on year. Hunters up 112%. And a large element of that is down to cost control. Now, don't for 1 minute think they can do the same thing again in 2021. Despite the booming market, which will drive extra cash in, they will have to spend some money that they didn't spend in 2020. But it'll still be a very good cash contribution from Hunters in 2021. And then on the right-hand side, MSF, we think we've done pretty well on sort of growing our MSF over the years, up 36% from 2016. Hunters up 35% from 2016. Two reasons why it was a really good fit for us. Over to you, Gareth.
Great, thanks, David. So just to give you some sort of colour as to what we now look like as a group, we're now the UK's largest property franchisor. We've got 9 brands. MartinCo Hunters are our 2 traditional high street national brands. EweMove's our national hybrid offering. And then we've got a range of regional brands, CJ Hole, Parker's, Ellis Co, Country Properties, Mullocks and Whitegates up in the north. So 9 brands. All very successful in their own right. That gives us, as a franchisor, significant scale. We've got 430 trading branches. We've got 135 actually EweMove territories, because that's grown by 20 in Q1. We've got over 73,000 properties under management, and we'll sell in excess of 20,000 residential properties this year. And I guess what's the vision? Now, as a combined group, is to achieve an increasing UK market share of lettings, estate agency transactions and property-related financial services using what is now a proven franchise model with multiple and clearly differentiated property brands. So that's what we've become as a result of bringing the 2 companies together. Impact on enhanced scale, and we've touched on a lot of that. It does create the largest property franchisor in the UK. We are managing the 2nd largest estate agency network and portfolio of letting properties in the UK, and it gives us the ability to, or the opportunity to properly exploit the existing and additional income streams within the enlarged group. So both businesses have not really embraced all of the opportunities throughout the sort of cycle to earn money, and it's a real driver of mine to make sure that we get those income opportunities in for each franchisee to make the very, very best of their business, to drive their profits and ultimately enhance the result across the group. The opportunities that are immediately flagged up, and again, I'll talk about some of our strategy a little bit later, but clearly to grow the lettings business across Hunters, really, really important to us, through probably local portfolio acquisition funded by the franchisee, to continue to grow the sales business within the property franchise group's old traditional brands, so MartinCo, Whitegates, CJ Hole, Parker's, and we started that in September, and that's really started to move forward. I think partly market driven, partly hopefully a bit of what we've done, to cross sell additional services, and that's financial services, insurances, tenant referencing, tenant insurances, utilities, all of those opportunities. Conveyancing exists today, and we need to get better at those, but that's a real opportunity for us. All of it will be backed up by best-in-class digital marketing and really defining what that customer for life journey looks like, and we're investing some money in that and some real focus to make sure that we provide the very best communication to all of the customers that we deal with. A sort of sub benefit of doing the Hunters deal is that they've developed their own internal IT system that's been written by an external company, but that system is actually going to replace our current Eureka system within EweMove, which is coming to end of life just because of the growth of EweMove, and Skipper's a really good fit for the EweMove business moving forward. So that comes as an additional benefit of the acquisition. And as David and I have touched on earlier, to continue to grow that Hunters footprint, to continue to attract existing independent estate agents that see having the Hunters brand over the door as beneficial to them in terms of growing their business in the future. So that's a little bit of the opportunity. To give you some idea of Q1 trading update, and just to sort of caveat this, the market at the moment is probably the busiest I've known in 30 years in the industry. Okay, so the figures are exceptional. They have continued all the way through Q1 from a sales perspective, which suggests that the income, as David touched on, will be secure and robust through to September. And ultimately, will it continue to be so busy is the $100 million question. I think to give some sort of clarity to that, there was a really good piece done by Savills recently that talks about this year achieving 1.5 million housing transactions. Now, if I go back to the last normal market, which would have been 2019, there was about 925,000 transactions. And if you looked post credit crunch, once it got back to, 2012, 2013, 900's about the right level, 900,000 transactions. So Savills are saying this year probably 1.5, so that's definitely, a boom. But the really encouraging piece is their predictions for 2022, 2023, 2024, 2025, flat at around 1.2 million. And if we get 1.2 million transactions for the next 4 years against 900 that we've had to trade with for the last sort of 8 years pre-COVID, that is a really healthy, strong market. And I think what the government has done is really shown a commitment to the property market in terms of the initiatives that they've put in place with the stamp duty holiday, but more recently the view that they want to move generation rent into generation buy, they've launched a government-backed 95% mortgage in the last few weeks. The mainstream lenders came out with their products last week. So there's undoubtedly a political commitment to ensure that the housing market stays strong. The predictions are we'll do 1.2 million transactions after this sort of bubble passes, and that's really reassuring. So back to the Q1 trading update, you will see, record figures. So network income in the traditional brand up 13% to 23 million. Network income in EweMove doubled from 2 million to 5 million. So really impressive. And Hunter's network income's increased by 69%. From 10 million to 16 million. The sale agreed pipeline, that's the income, the forward-looking income piece for the next 3 or 4 months. The great news, as David touched on in Hunters, that pipeline hasn't really reduced. So the sale agreed pipeline in Hunters is up 45%, 11.3 million last year, 17.5 million on January the 1st, 16.3 million on April the 1st. So that's really encouraging that income will continue to flow through. Same story in EweMove. They've got a pipeline that's double that of 2020. And sales agreed pipeline in the property franchise group up 45% at 9.4 million. So that's really good news for the income over the next 3 to 4 months. Number of exchanges we've done this year, up 49% in the traditional brands, 2,500. In EweMove, double, 1,200. And in Hunters, up 1,500 at 4,000. And you add that up in a quarter, that's 8,000 transactions that have completed across the group. And we were saying we will do in excess of 20,000 properties. So we're on a run rate to do significantly better than 20,000 this year. In terms of rental properties, pretty flat, as David talked about, 55,000 properties under management in the traditional brand, 3,000 in EweMove, and 15,000 in Hunters, which gets us to the 73,000 that we've talked about throughout the presentation. And then, what's our growth opportunity? We've talked about Hunters and that they're very good at converting independents. We've talked about EweMove, the fact they've had a record quarter on recruitment and sold 20 new territories in the quarter with a pipeline that suggests we'll do at least that in Q2. And we've launched a new initiative, or we launched back in September, actually, a new initiative in the property franchise group's traditional brands that was hub and spoke. And that gave each franchisee the ability to look at their territory and identify an area close to their main office, but just outside of their territory, and set up a hub, a sort of self-employed hub type arrangement. And I'm delighted that, 7 7 existing franchisees have decided they want to grow their business and have taken on one of the new satellite offices, and we have 10 or 12 lined up for Q2. So that's probably driving growth within the old established business. In terms of office count, we've got 430 offices between us, 210 in Hunters, and 235 in a property franchise group, and we've now got 135 separate businesses, territories in EweMove. So you add all that together, you're up to 550 businesses operating under the brand. Strategy and outlook, and I'm going to touch on what we talked about back in September and the progress that we've made, along with what's our plan for the next 12 months. Our purpose as a business, and we've really sort of defined this to our franchisees in this new sort of agreement of working together. Our purpose as a business and every individual within head office is to support the franchisee and to help them become more successful. And sometimes I guess you lose your way with that because you're running your business and they're running their business, and you sort of forget that you're sort of intrinsically linked. And I think we've pulled that back together, and the relationship we now have with our franchisees is exceptional. That sort of reinvigorated them in terms of wanting to buy into the opportunity that exists. I'm delighted. So our purpose is to ensure our franchisees become even more successful. In terms of how do we go about making them more successful, that sort of comes down to our strategic growth initiatives. And I've touched on most of these, but just to make the point, lettings growth. We have a huge opportunity managing 73,000 properties to organically grow our income of our lettings portfolio, and that's achieved through rent increases. We take a percentage of the rent that the landlord gets, so the rents go up, our income goes up. Converting tenant-find landlords that do their own management into managed landlords, and there's never been a better time to do that because the amount of regulation that's coming into the private rented sector is there's 160 different bits of legislation, I think, that's come in the last 2 years. So actually, if you were a landlord, you wouldn't really want to manage your own property. The liability that you take on is far greater than the 10 or 12% you'd pay away to an expert to look after it for you. So again, internally through our digital marketing strategy, connecting with those tenant-find landlords and educating them about the changes in legislation that have happened and the ones that are coming is our job, and to try and encourage a high percentage of those tenant-find landlords to become a managed landlord with our franchisees. So that's strategic growth initiative 1. Expanding our residential sales activity and footprint. So the sales activity piece I talked about in September, that our traditional brands, certainly MartinCo, had a huge opportunity to increase the number of residential sales they did in their locations, and we've put some specialised help in for them to analyse the opportunity and to agree that they want to take that growth initiative on. And we've had about 30 offices that have invested in dedicated staff to drive that residential sales result, which I'm delighted with. And that's work that's ongoing. This isn't something that's going to be achieved just this year. This is sort of a 2, 3, 4 year plan. EweMove recruitment, stated aim back in September was to double the size of the territories from 115 to 230. And we're making superb progress on that, with 135 now already secured, with at least another 20 we hope coming in Q2. Financial services growth, this was one of the areas that for years we'd sort of underperformed in, and I think we've taken some real decisive action with our announcement yesterday with LSL. And the work starts today in terms of defining which tier those financial advisors want to be part of, and developing that business over the next few years. Acquisitions, one of the things we talked about in September was wanting to buy one of our peers, and we've achieved that with Hunters. Would we look at another one? Absolutely, if it came available. But I guess the biggest point on acquisitions now is to buy local portfolios in collaboration with our franchisees. So we've identified which franchisees have an aspiration to do an acquisition, and we're working really hard in those territories to identify the businesses they may be interested in, and then we'll help them negotiate the price accordingly. We've also got Hunters that have never really embraced the sort of portfolio acquisition piece, and and there's a big opportunity there. I think it's fair to say when we were the smaller group, we had 230 offices. We only had 230 locations in the UK where we could consider a portfolio acquisition. And one of the great things with the Hunters piece is that we've now got 400. So we can take advantage of more opportunity as a result of having more locations covered. And then backing all of that up with a sort of best-in-class digital marketing strategy that really takes the customer from the start to the finish of the process. And rather than having a sort of kiss and forget relationship with them, then developing that relationship for the long term, and that customer for life sort of strategy that no one's quite got right yet. And we want to invest some time, effort, and money in terms of fine tuning that and making sure that continually drives leads back into the franchise offices. So we've bitten off a lot there, and if it was just me and David sort of overseeing that would be pretty unrealistic. So the final, I guess, part of the jigsaw that's important for you to understand is we've also invested in our management team since September, and then we've got a slide that shows our new MDs, and the nice thing about this is the complementary nature of what they bring to the party. So back in early October, we recruited Eric Walker as MD of MartinCo South and Scotland. Eric's background's very much franchising. He ran the Northwood franchising group and then became group managing director of Belvoir before he joined us, and brings, as I say, massive franchising knowledge and massive lettings and compliance knowledge. So that's his bag, and he's very good at it. We then recruited Gareth Williams, who is MD of MartinCo Midlands and North. I've worked with Gareth a number of times over the years, and Gareth really is a specialist in the sort of sales improvement, residential sales improvement and financial services arena. He's CMAT qualified. So, we've got franchising, we've got compliance and lettings, we've got residential sales and financial services. Kate Randall looks after the Xperience group of offices, so Whitegates, Ellis Co, CJ Hole, Parkers, as MD, and she's also my group marketing director, so oversees that digital strategy that we're talking about. Nick Neal is MD of EweMove, and Nick was actually a EweMove franchisee before he became MD. So he set his own EweMove business up, ran it very successfully, and when the founders decided to leave, decided he wanted to run the whole business. So he's passionate about the brand, he's passionate about franchising, and is absolutely the right guy to be running that business. And then we've got Glynis Frew that's joined the team as part of the Hunters acquisition, who is passionate about customer service and passionate about training, and will drive our compliance to the ROPA initiative that will come in this year or next year. And already within Hunters there's a training company that has a Property Mark accredited exam for their staff. So they're really passionate about qualifications in the industry, and that will really help the whole group over the next 2 years, because there is going to be a shift, and we want to be at the forefront of that. So again, go back: lettings, compliance and franchising experience, training, compliance, and customer service experience. Kate, marketing director for the digital journey, Gareth, financial services and residential sales. And I think what we've developed and what we've built is a really strong team of people that will deliver that strategy that we talked about at a local level, that will then enable David and I to continue to look for opportunities on a bigger scale that will enhance the group still further. So our changing market, so again, we've covered a load of this, but increasing interest in the hybrid model. I think lockdown has shown us that people will do things differently going forward, whether that's working from home instead of going into the office 5 days a week, whether that's setting your own business up, whether that's finally striking that work-life balance that has been just out of reach pre-COVID. And I think that's driving this interest in the hybrid model, and we're taking full advantage of that at the moment. The customers' changing preferences, we talked about the digital journey, but we're now seeing people that will do mortgage appointments on Zoom. They are very happy to be dealt with via the telephone. They will do a virtual viewing on a property. So, it's really important that, again, we're at the forefront of this prop tech that enables customers to be served the way that they want to be served, as opposed to the way we want to serve them. And as I say, touched on this again earlier, government support underpins everything that we're doing. You looked at, we came through COVID as a result of the furlough scheme and the business rates relief. We came out of COVID as a result of the, government reopening us quickly and then putting in place a stamp duty initiative. And that's going to be further underpinned by trying to make generation rent become generation buy over the next 3 or 4 years. So we're really encouraged by the government stance on the property market at the moment. So outlook, an exciting period ahead. I think there's a lot of work for us to do, but all of it drives income to the bottom line. So underlying activity levels in the second half of 2020 are flowing through into 2021 and are continuing to grow. So we're really pleased about that. We've got supportive external markets with underlying demand, and that's expected to continue. We will pursue even more opportunities following the Hunters acquisition. That's just one part of our strategy. And then focus and ability on executing and refining our strategy. So we're now into questions. So any questions, please feel free to ask.
And we have a question here asking for a bit more detail about your financial services model. Your model differs from that operated by Belvoir. Why have you chosen your model, and what is the advantage that you see to a commission-based model?
So I don't think it's that different. I think we've taken the risk out of it. So we haven't acquired, spent millions of pounds acquiring a business. What we've done is a very beneficial deal to the group for Primus to provide those compliance services. I think the income will be similar. So I think, there is a mortgage network. There are some financial advisors that will pay the branches commission, or the branches will employ their own financial consultants. So I think that's quite similar to Belvoir. I think the difference is that chunk in the middle, the cost piece of building a centralised compliance piece and paying for it. And I think the deal we've done means that we don't have to do that. And so it's less risky, it's less costly, and I think it will become more profitable.
Thank you. And you say you're going to grow market share. From which companies or sectors do you anticipate this growth is coming? And also, which sectors of your business is the growth going to come from? Sales, letting, or financial services?
So all of the above, I suppose. But in terms of market share, the initiative within the traditional brand is to grow the residential sales footprint. The EweMove piece are already delivering on their market share growth post-lockdown. Hunters' market share is tracked every month, and again, their initiative is to move that forward. If I look at lettings, that's through acquisition predominantly, and our organic lettings growth. So part of that's the digital marketing journey by attracting tenant find landlords to come across to managed, and that's within our hands, and that will give us a bigger share of that market. The Hunters piece will be about acquisition of portfolios because they're starting from a fairly low base. So the different aspects of driving it. Financial services, we don't do much financial services, so it's going to be really easy to increase our market share, but that will be across the group. So we want to grow all areas of all businesses. It's not one business is going to do this and another business is going to do that. We've got a management team that has that growth plan. They've communicated and talked to each of the franchisees and understood what the franchisees want to do in terms of where do they see the potential in growing their business. And they can't do 6 things at once. They can only do 1 thing at once or 2 things at once. So I think all of them will do financial services. Some of them will do lettings, organic growth and acquisition, and some of them will do residential sales growth.
Thank you. And what's the average number of properties per landlord that you deal with? And are you seeing this growing per landlord?
So average number is 3, if you take the average, but that average is really misleading. So I'm not sure you take much from that. So we have a lot of single property landlords, and we have a lot of landlords that have 15 to 20 properties under management. But if you average it, it comes out at about 3.
Thank you. And do you have blocks lettings in your programme, and is this an opportunity to expand?
So block management we're looking at the moment. So we've been, we're talking in partnership with a company called Beehive. It is specialist. We've got a number of franchisees that have a desire to do it. We've found a sort of what's the word, like low risk environment through Beehive, where they take a lot of the day-to-day risk away from that. And I can see that as an area of the business that will grow over time. And locally, there's loads of opportunity for block management to grow a letting office's income.
Thank you. Your Q1 figures are impressive. How do they stack up against Q4 rather than year on year?
So interesting. So Q4, and David touched on this. The market reopened in June. Sales agreed went quickly up, but everybody was still sort of working from home. So the surveyors struggled to get out, and they were still working from home, and they were of an age where they didn't really want to go out and do valuations. The conveyances were working from home, and they didn't really have the technology in place to effectively work from home with the volume that was coming through. Local councils were working from home, so the local searches in some cases were taking, I don't know, three and a half months to come back. I think Harrogate local council said they were going to take 4.5 months. So although the market was really active, nobody could do the transaction in a timely manner. So I think the Q4 against Q1 comparison would be misleading. So Q4 was very, very active from a sales perspective. Q1 is busier. From an exchange perspective, Q1's much busier because that logjam sort of, getting better. And the income in Q4 was, December was good, November was okay, October was disappointing. I think it would be where you take that half year sales result. In terms of lettings, really, really resilient, quite flat, but really, really positive for us as a group. So most of the, you saw that big spike on the graph. Most of that spike's come in Q1 and will continue in Q2.
Thank you. And how would your strategy and profitability be affected if we did return to 900,000 property transactions in 2022, given the surge in 2021?
If you looked at the property franchise group's 2019 result, it was really impressive. You add on EweMove growth because there's more territories operating. You add on the strategic growth initiatives and you come to a figure. You then look at Hunters and you go back to 2019 and you take off the fact that we haven't got two boards, we haven't got two listing charges, we've made some synergies. They cut out some costs as a result of COVID. And as I say, but ultimately, I guess we made the decision to buy the business, not because the market was busy, but because of the figures from 2019, coupled with the synergies, coupled with the cost savings they'd made during COVID. And that stacked up for us. Therefore, that would be the result we go back to. That'd be the minimum we'd accept. So, every set of stats we look at, we are incredibly positive about the future, irrespective of whether it's 900,000 transactions or 1.5.
Great, thank you. And if Generation Rent moved to Generation Buy, won't it have a negative impact on your rental business?
So it's a really good question, but no, because the demand for rentals is just, I could let every rental property 3 times over in the first week. So it would just bring in a new generation of renters. And they're the people that are probably at home at the moment that would consider it if the right property came along. So, this thing won't happen. 73,000 people won't move out on Tuesday and we need, suddenly 73,000. The demand for rental property just is never diminished. There are always people that want to take a rental property. You look at the time on market for any 2-bed apartment, 3-bed apartment, it's just days. So no, I don't think the generation to generation, we'll just create another generation rent and move, like the last generation rent into Generation Buy.
Thank you. And have EweMove sales and listings records in 2020 been broken in 2021? I presume that means just for the first quarter.
Yeah, okay. So sales records, yes. Listing records, no. So there is a stock not issue, but because the demand is so high, everything's selling really, really quickly. So the difference in a normal market, you'd put 10 houses on the market and 6 of them would go through to completion, or 6 of them would sell. At the moment, put 10 houses on the market, 9 of them are selling. So I don't need as many instructions to deliver the same result as historical averages or historical ratios. So we are breaking sales records. We are not breaking listing records. I still think there's some pent-up supply because I think COVID has put people off putting the house on the market, and until they have that second jab, they're not going to feel comfortable with people traipsing around their houses viewing. So there is still a percentage of the market that is fearful of COVID, and I think that will play out and come to the market later in the year. So I think the traditional profile of quarter 1 and quarter 2 being your busiest listing months will be different this year. I think it's already different. And I think we'll see more stock come into the market quarter 3, quarter 4.
Thank you. And do you have a presence in the new institutional build-to-rent market, including student accommodation? And if not, do you expect to break into this market?
There clearly has been some investment in both by universities and by some of the well-known institutions in rental accommodation. We are represented in a good number of the university towns up and down the country, and we represent landlords there, and that's our involvement really at this point in time. I suppose once we get into block management and it's not too dissimilar to then start looking at managing these portfolios, but not something we've looked at yet.
Thank you. And you offer great support for franchisees in terms of expanding opportunities for them. Do they have a training programme, and who runs it?
So the operation directors that report into the MDs run that training program. So a new franchisees will be inducted, but they'll take their exams, they'll be assessed, they'll be mentored for a period of time. We will buddy them up with a franchisee potentially, and they'll spend time in that office. But I think it's fair to say training is one of the weaknesses in the old property franchise group business, and not something that we've been good enough at. The great news is part of the acquisition, and because of Glynis's passion for training, they've got a training portal, which is Property Mark endorsed, and goes towards the Property Mark exams that are currently in place. That may be replaced by Roper. So our vision is that the whole of the group will have that training portal. All of the legislation training will be on there, all of the induction training will be on there, and all of the sales training will be on there. There'll be some external content that's provided by specialist trainers in certain disciplines. Each of the branches or each of the team members will have their own individual login, and it will be a brand specific training portal for all of our businesses. So I think just having that, and also being set up ready for when Roper does come in and the exams that need to be taken to get your qualifications moving forward, that's a really exciting proposition for us, and will elevate what we've offered our franchisees in the past significantly. And Glynis will oversee and run that for us. So incredibly excited about that.
Great, thank you very much indeed. And that's the end of questions. Gareth, do you have any closing remarks?
Just thank you for your time. I hope you've enjoyed the presentation. I hope you see what we see in terms of a business that has performed incredibly well over 2020, but has put in place a sort of growth plan now that will take that business massively forward over the next 3 years and see it as attractive. But seriously, thank you for your time. Thanks for joining.